This is a media briefing on the recommendations of the Governing Council's High-Level Task Force on Recommendations. These proposals are proposals to simplify the European regulatory, reporting and supervisory framework. My name is Esther Tejedor, and I am today with ECB Vice President Luis de Guindos, who will shortly present the main recommendations. Let me just remind you that on our website, you can find a press release and a detailed report with the 17 recommendations of the Governing Council. In parallel, you can also find on the ECB Banking Supervision website a report on the ECB's agenda for a more effective, efficient and risk-based supervision. This is under the title Streamlining Supervision, Safeguarding Resilience. It describes ongoing work under the existing legislation and therefore complements the Governing Council recommendations. Lastly, on the website of the European Systemic Risk Board, you can also find a report with simplifications of its tasks. Now, I give the floor to Vice President Luis de Guindos. He will focus his remarks on the 17 recommendations of the Governing Council to the European Commission. Please, Vice President.
Thank you very much, Esther, and good morning to everyone, and welcome for joining to this presentation of the recommendations that we are going to make to the European Commission. The recommendations were prepared by the high-level task force, as Esther has indicated, and simultaneously afterwards approved by the Governing Council. These are recommendations, and this is to make a difference with the report, for instance, that it has been prepared by the SSM. And these are recommendations that, to be implemented, require a modification of the legislation. And so we are not the legislators at the ECB. And so these are recommendations that are going to be treated as an input by the European Commission in order to elaborate the report that they are preparing now about the competitiveness of the banking industry. First, with respect to the high-level task force, let me start showing gratitude to Governor Miller, Villeroy de Galhau, Nagel, Panetta, and Governor Wren, and ECB representative to the Supervisory Board, Sharon Donnery. They were members, the principals of this high-level task force, and their deputies for their very important and substantial contributions. Having said that, let me go to the main purpose of this report and these recommendations. Our objective was to enhance the efficiency of three main areas: regulation, supervision, and reporting, and thereby avoiding unnecessary burdens. Overall, our prudential framework works well, but we identified some areas for improvement. There are four main principles and red lines that have guided our work. Simplification efforts should maintain banks' resilience. And by banks' resilience, we mean the level of capital of the banks. We do not want to try to undermine the present situation of capital of the European banks. We aim to achieve the same level of resilience in a simpler manner. The regulation, which could lower resilience, is not in Europe's interest. Capital and liquidity buffers should not be reduced. Second, the revised framework needs to ensure that microprudential, macroprudential, and resolution authorities are all able to meet their respective objectives. Third, European harmonization and financial integration should be fostered. And finally, and this is something that is quite relevant for us, international cooperation should be upheld. Basel III should be fully, timely, and faithfully implemented by all jurisdictions. Turning to the first area, to the recommendations, to simplify the regulatory framework. The report contains 9 recommendations in this area, and I will highlight not all of them, but some of them. We believe that these are, the most relevant ones. The first one, the first recommendation is to reduce the number of elements in the risk-weighted and leverage ratio framework. Specifically, to merge EU risk-weighted buffers into 2. non-resealable buffer and a releasable buffer. Pillar 2 guidance, that now is determined by the SSM, would be kept independent on top of the releasable buffer. The second recommendation refers to the quality of capital. And here the recommendation is that quality of capital in the minimum requirements should be increased. Two options are proposed here. One is to enhance features of AT1 instruments to ensure their loss absorbing capacity. And the second alternative is to remove non-equity instruments completely from the capital stack of an operating bank. This last option, nevertheless, would raise difficult questions with regard to maintaining resilience, capital neutrality, and Basel compliance, which are agreed principles of the high-level task force. The third recommendation that I want to highlight and to bring to your attention is that we recommend a dedicated, prudent, and materially simpler regime for smaller banks, building on the existing EU framework and introducing significantly more proportionality. Proportionality is the element that we want to introduce here. Another recommendation is for the framework that applies when banks fail in resolution. We recommend aligning the resolution requirements which apply to all banks, what it is called MREL, more closely to those that apply to the global systemically important banks, TLAC, without reducing resources of a failing bank. Another recommendation in this area is that the EU-wide stress test methodology should be simplified by streamlining its methodology and scope. And finally, picking up, the most important recommendations, we recommend introducing a European governance mechanism whereby the Governing Council of the ECB takes a holistic view on the overall level of capital within and across bank union. Let's move to recommendations, to our recommendation for supervision. You have it there on the slide. And again, these are recommendations that require legislative action, as I have said before. The most important one is to strengthen and complete the EU single rulebook to simplify supervision and help deepen the internal market in banking. This should involve reducing the complexity arising from diverging national powers. But finally, the third area that we have focused in terms of the simplification effort is reporting. And here we recommend establishing an integrated reporting system which could be applicable across statistical, prudential, and resolution areas to eliminate redundancy and facilitate the multi-purpose use of data. And we propose to reduce the number of data risk submissions required from banks by establishing a supervisory tolerance margin for minor errors to be disregarded. This should lower banks' administrative costs. Separately, as has been mentioned by Esther, but related to this report, the banking supervision colleagues have just published a report that focuses on simplified supervision within the current legislative framework. These are internal actions, let's call it that way. The proposals in this report that have been elaborated by the Supervisory Board and the SSM do not demand any sort of legislative change, are internal actions for us. And in addition, it has been also referred by Esther, the European Systemic Risk Board made proposals for how to simplify its tasks. And we welcome these contributions, which complement the work done by the high-level task force. And with that, I am totally open to take your questions.
Very good. So now, please, as usual, you raise your hand, and then we will basically start giving the floor. We would be very grateful if you can turn your camera on. So the first hand that we see, let me check, who is the first raise hand? Sorry. Let's see the first hand here.
I can see them.
Yeah, sorry.
Esther.
Yeah. One sec. Yeah. Okay, so the first one is Catherine Carlos, please.
Hi, thank you very much. Catherine Carlson from Politico. To what extent do you think the recommendations will change European banks' ability to compete internationally? And also, these recommendations will now be sent to the Commission. Do you think the Commission will be receptive to them, or do you think the Commission will change them a lot in their own banking report? Thank you very much.
Thank you very much for both questions. Well, these are inputs for the European Commission, and we have had some communication with the European Commission. You have to bear in mind that what we are recommending here are, let's say, high-level recommendations. We are not entering to the nitty-gritty and into the concrete detail of each one. We are proposing policy lines, recommendations for them, and afterwards the legislators, will have, they will take into consideration, and I hope that they will, these recommendations, and afterwards they will have, to define the way that they modify the present legislation, the present regulations, etc., etc., etc. But my impression, and as you can imagine, we had some contacts with the European Commission, is that these proposals can be taken into consideration by them, because we have the expertise in that regard. And are these proposals going to make the European banks more competitive? Well, I think that what they are going to do is to have a more simple framework for them, and to start to reduce unnecessary burden. As I have said from the very beginning, we are not going to undermine the capital requirements of the European banks. We believe that this is a clear advantage for Europe. We have to take into consideration, for instance, that lately, we had some issues in the US with the regional banks, and Switzerland with Credit Suisse. But we didn't have any sort of, let's say, similar accident in the banking industry in Europe. And I think that this has to do not only with the supervisory work that is done by the SSM, but as well with the regulation that we have in place. We believe that capital levels do not limit the capacity of the European banks to lend to the real economy.
Next one is Andrés Stumpf, Expansión. Please, Andrés.
Thank you. I have two questions. The first one would be about the small banks' preference treatment. Do you have any preference or a set of standard on how higher should be the bar for this special treatment? And the second question: banks have asked for a change in the mandate on the supervision of the ECB, asking for some similar treatment as the one of the Bank of England, who looks after the growth of the banking sector. I was wondering if you had any comments on that. Thank you.
Well, thank you very much. With respect to small banks, what we are, I refer to, to the comment that I made before. What we say here very clearly is that we should have, a special, let's say, a particular, more simple framework for the small banks, proportionality. We do not recommend, what is implemented in the case of the US, that they have, a small and medium-sized banks, special regulation. We do not believe that. We refer to, small banks. Afterwards, this proportionality will have to be implemented. What we are is making a call for more proportionality. And afterwards, the legislators, that is the European Commission, the Parliament, and the Council, they will have to decide where to put the bar. But here, the proposal is very clear. It's crystal clear. More proportionality on both the capital stack and supervision should be, proposed and should be set up for small banks. In other words, the question of the modification of the mandate of supervision, we do not enter that. That's nothing, the mandate is quite clear. The mandate is in the treaty. And I think that we should respect that. And I reiterate again, I think that, the job that the SSM is doing, is good. And I think that you have to compare, the kind of accidents that we had in other jurisdictions and the situation in Europe. This is the combination of good supervision, in our view, plus a regulatory regime that, improves the financial stability situation of the European banks.
Thank you. And now, Lex, Fanny Rooks.
Hello, can you hear me?
Yes.
Yes, we can hear you.
Good morning. Thank you for the briefing. I have a follow-up on one of the recommendation you mentioned, the 10th one. That is to complete the supervision rulebook. Could you elaborate a little bit on this? What would it mean in terms of regulation, for instance? Thank you.
Well, it would mean that, the supervisory rulebook, the single supervisory rulebook, is something that, to eliminate discretions and different approaches that you have, at the national level. It's very important to have, let's say, a sort of harmonized approach with respect to supervision. Bear in mind that the SSM is the supervisor of the large banks. But afterwards, the national central banks, they have, responsibilities in terms of supervision of, smaller banks. And here, what we propose mainly is to try to get rid of, the discretions, national, regulations that are not identical. Because it's normal. If we are going to have, a banking union, in terms of supervision, the common rule book should not apply only to the banks supervised by the SSM. It should be applied to all the banks supervised in the euro area. And this is the main recommendation that we are doing here. And simultaneously, let me say that we are also recommending, and for sure that you will see it in one of the recommendations, that we are recommending a single procedure in order to analyze the European banks, using the stress test and using other kind of calibrations. But we are asking here for a harmonization of the approaches, the regulations, the internal and domestic norms that are applied by the different national banks. It's not only, the SSM is the single supervisor, but as I have said before, the national central banks, they have also, some responsibilities with respect to smaller banks that are not under the umbrella of supervision of the SSM.
Nick Comfort, Bloomberg, please.
Hi, good morning. Thanks for the chance to ask a question. One of the most exciting things in the report got some of the least text, and I'd like to ask about the changes you are suggesting for AT1 to make it more loss absorbing. What specifically do you have in mind? I think the AT1 markets are very interested in learning some details on this.
Well, I think that you have to put it, in the context of the, let's say, the recommendation. Here we have proposed two alternatives. The first one would be to remove AT1 and AT2 from the minimum capital requirements, and we say that this can have some, not positive consequences that you will see. You can read it in the report. It would not be Basel III compliant, that proposal. And secondly, the first proposal that we make in this, in this area is to try to improve the loss absorption capacity of AT1, as you have said. What does this mean? Well, this means that, AT1, if we go into the characteristics, they have some concrete features. And, modifying these concrete features, that is not for us, is for the legislator, you can improve the loss absorption capacity. And what we are saying at the end of the day is that AT1 should be closer to equity. That's the proposal. We do not enter into the concrete details. And this is something that I said at the beginning. But, AT1, to improve the quality of AT1, is that AT1 should be more similar to equity in terms of the characteristics that equity has in comparison with AT1 or T2.
But just to be clear, so maybe it's since it's going concern. I mean, you're maybe the issue at hand is like the skipping of coupons. Is that the main thing you have in your mind?
We do not have any concrete. We do not enter into the concrete modifications. But I think that the direction of the proposal is clear. They should get closer to equity and to improve, the capacity of the loss absorption capacity of the instruments. It's not only the coupon. There are other elements that they can be taken into consideration.
Okay, I tried. Thank you.
You tried it. Reuters, Balas Koranyi, please, Balas.
Hello, good morning, and thanks for this. My question is also about AT1s. You present two options in the document, but clearly you put a lot of disclaimers around one of the options, as you said, non-compliant with Basel. And does this signal kind of a preference at the ECB for out of these two options, which one you would prefer? And if the second option comes with so many hurdles, why are you even putting this in the recommendations? Because it seems to me it's kind of like a non-starter. But I would love to hear your thoughts. The second is about the small banks and the way you envisage this. How many more banks would fall into the small bank category? Like how would that pool of banks increase given this recommendation? Are we talking about kind of a large substantial increase in the number of banks treated under this regime, or we're talking about just a modest change?
Well, I will start with the second question. Thank you very much for the two questions that you have asked. Let me say something. The question again, because I think that this is the nature of the proposal here. We are making recommendations and we are putting forward policy lines. We do not enter in how high, how low the bar should be set up. That's not our mission. What we really believe, is that smaller banks, and you can have different definitions, and this is something that we should be discussed at the level of the legislator, should have a much more proportional supervisory and capital stack framework. That's the proposal. For sure that you have to simultaneously take into consideration that this will be the starting point of the discussion that we will have with the legislators. And we are not the legislators. We can make proposals to them. And for sure that we will have contacts and we will have exchanges with the legislators, and we can give them the pros and the cons of each one. How high, how low the bar should be set up. But the direction of the recommendation and the proposal of the recommendation is clear in that respect. A more streamlined framework for small banks. And you have there, for instance, what's happening in the UK or what's happening in Switzerland. I think that in the case of the US is a different animal. But the reference of the UK and the Switzerland is something that we could take into consideration. The point of 81, this was one of the points that we discussed in depth in the high-level task force, and there were some members in the high-level task force and in the Governing Council that were in favor of option 2, that is more radical. Only equity could be acceptable. And option 1 also had a lot of support in the high-level task force and in the Governing Council. So and as you have said, with respect to option 2, we have put some disclaimers, but we try to be as neutral as possible with respect to this recommendation. This is something that has implications, as some of your colleagues have indicated, in terms of the pricing of 81 and 82. And this is something that we'll have to be gauged, to be calibrated in the future. But Here, well, we put, you call it disclaimers. What we try to do is to say, the kind of consequences that this second option might have, and in comparison with the first proposal. And what is important is that there is an embedded implication in both alternatives. Is that the quality of the components of the minimum capital requirements should be improved.
Thank you. So now Levente Correa from Central Banking Publications, please.
Yes, good morning. Thank you very much for the report and the briefing. My two questions. The first one pertains to governing council members having come out and called for a closer understanding between the sort of bank and non-bank nexus. How do you see your proposals today affecting your insight into the murky nature of the non-bank sector and some of the risks hidden in there? And the second one is that one of the recommendations reads that the resolution planning requirements for non-GSIB banks should be closer aligned to GSIBs. Would this not increase the regulatory burden on some of those banks, or how do you see this playing out? What was the reasoning behind this recommendation? Thank you very much.
Well, thank you for the question. As you know perfectly, one of the main points and the main risks that we have identified in our FSR is the link between banks and non-banks. And we are, what we have said is that even that, I don't know whether, non-banks are becoming the best client of the banks, but, are becoming one of the largest clients of the European banks, and that, this interconnection needs to be overseen, because it's there, given, the level of leverage and the liquidity mismatches in the non-bank sector, well, that could have, repercussions on the solvency of the European banks. But, and this is, I would say that now, perhaps it's one of our main concerns with respect to the solvency and the financial stability implications of, in Europe now. But here, we are not dealing with that. And we recommended, a macro-prudential toolkit for non-banks, and we recommended, to improve oversight, and even, to strengthen the supervision of the non-banks. Now, well, you have seen that the European Commission, they have produced a report with respect to capital markets that I think that is dealing with this kind of situations. But here, we are not specifically treating any sort of recommendation. We are focusing on the, how to simplify the regulatory framework of the European banks, without undermining the solvency and without undermining supervision and without undermining, the regulatory framework at all.
Olaf Storberg from Financial Times, please.
Hi, good morning. Can you hear me?
Yes, we do.
Yeah, thanks for taking my questions. I have more than two, but will limit myself to two in this round, but would also already like to flag that I have follow-up questions then. My first round of questions is kind of going back to the AT1 issue, and also your opening, one thing you said in your opening remarks, where you said you want to increase the quality of the capital. First, conceptually, I mean, the whole thing is kind of framed as a simplification attempt, but isn't increasing the quality of the capital a tightening of regulation rather than kind of a simplification? That I'm slightly confused here. And then, is this referring to this AT1 change, this remark in your opening, from your opening address, or is this relating to something different? And if so, what is it? And also, could you maybe explain the rationale behind this idea to make AT1s more like equity? Is this reflecting, do you want to move more to the Swiss way, how they dealt with AT1s in the Credit Suisse kind of wind down, where it got wiped out? Is this what you have in mind, that AT1 owners have to bear more of the losses in terms of, or more of the damage in terms of crisis? Why do you want to do this? Thanks.
Well, I don't know whether, your question is whether, this recommendation simplifies or not. And I believe that it simplifies and it clarifies. No, sometimes simplification is linked to clarification. And, in this case is connected with, a policy recommendation. Now, you know perfectly that the kind of debate that was opened with the pecking order that was applied to the resolution of Credit Suisse, and I think that it is important when you are talking about minimum capital requirements to try to send the message that it could be a clarification, that in both alternatives, in one is quite clear, in one, it's only equity, and the only component that is going to be accepted. But that, this clarification, that in my view implies also simplification, should give rise to an improvement in the loss absorption capacity of AT1. I know, well, AT1 has a lot of characteristics. One was the coupon, others have, there are other kind of features. And I think that to send the message that AT1, if that alternative is taken and is approved, is followed by the legislators, AT1 will be more similar to equity. And I do not think that this is a tightening at all, because in this case, AT1 will continue being, part of the minimum capital requirement, but simultaneously we sent a clear message and a clarification that, in our view, will reduce the possibilities of having an AT1 that is not equity similar, and that's why we believe that this clarification will imply a simplification at the end.
Oh, and why do you think the simplification is necessary with regard to AT1?
Yes, we think that to send that message is a clarification that it will imply simplification in terms of the understanding of institutional investors about the kind of elements that we're going to accept as minimum capital requirements.
Okay,
Next one is Michael Harley from Environmental Finance.
Good morning, thank you. And as you may guess from the name of the publication, my question will be focused on some different topics than a lot of the questions so far. But I was just hoping to get any further context on the information you're able to provide on your thinking of how sustainability and the climate aspects might fold into simplification, given that's been a focus of a lot of the requests of banks I've spoken to, and also broader context of simplification of corporate sustainability reporting requirements. And I recognise in this report it talks about simplification of reporting, but not so much sustainability. So I just wondered your thinking on that, but perhaps I wondered also whether it's, given that a lot of the ESG and climate elements are newer, perhaps that's not likely to be part of this, but any clarity you're able to provide would be helpful. Thank you.
Thank you very much for your question. Well, what we say here, we do not enter into the content of the reporting per se. What we are recommending here is to have a single channel, an integrated channel, and a single platform. Afterwards, the question of the content is of a different nature. And you know perfectly what's the position of the ECB, and now the discussions that we have with the European Commission and this kind of things. But we are not entering into the concrete composition of the reporting. What we say is, let's have a single channel, an integrated one, that banks, with this, through this platform, through this channel, will have, a single instrument to communicate with supervisors, and afterwards, a platform that will be shared by the different supervisors. But we are not, let's say, making any sort of assessment, any sort of evaluation about the content of the information. It's about the concrete channel, of the information in terms of communication between the banks and the supervisors.
Okay. Thank you.
Nikolai Stoyanov from Economedia Capital Weekly.
Hello. Thank you for taking my question. My question is actually on this new division of non-releasable, releasable buffer. And as it says in your communication, at bad times, the releasable can be released. Can you elaborate a bit more on that? Because the whole idea of having a buffer is to be releasable at certain conditions. So it's not a minimum requirement. So what will be the conditions? Who would be able to release them, and why not? What does it mean non-releasable? Don't the authorities have the autonomy to kind of lower them in terms of when it's needed?
Well, thank you very much for the question. You have to bear in mind that now, according to the calculations, there is not a single number, but we have more than 10 different buffers. And so here the recommendation is, let's go for two. One releasable and one non-releasable buffer. The releasable buffer is, the buffer for the macroprudential authorities that are national authorities. And national authorities, well, the ECB, we supervise what the national authorities do. We have even the top-up power just to complement it. We believe that a national macroprudential authority is not doing well, then we can jump in and we can start to modify the approach. But here there are different kind of buffers, sectoral buffers, CCYB. So what we say is, let's have only one. And let's have, and this is important, let's have only, a single fully harmonized approach for, the national authorities of how to determine this buffer. The logic of the releasable buffer is that you have to increase, these buffers in good times when credit is going up, and afterwards, in order to avoid a credit crunch, you can release the buffer in the bad times. This is the main element and the main reason of the releasable buffer. It has to be decided by the national authorities, but we should have only one, in order to try to cover all the different approaches, all the different needs that now the national authorities consider. And the second recommendation is a single approach to the determination of this buffer that should be applied by all the national authorities. Always we will have, the top-up power in terms of the ECB, but the recommendation is twofold. Only one, and with a common methodology about the determination of this buffer.
Next question is Sharon Tirkelvan from Risk Magazine, risk.net, please.
Thank you for taking our questions. I have one question relating to the proposed changes to the stress test. The issues that you mentioned could be taken into consideration are very far-reaching. Could you give some indication as to why this is necessary within the context of the other proposals? And to what extent, proposed adjustments to the stress test motivated by changes is also taken concurrently in the US? Thank you.
Well, the stress testing is, is an exercise that the attention that, has been moving over time. And even, the consideration of markets with respect to stress testing has been changed. And now, the process is very complicated. The process is that, we start with a top-down approach, and afterwards, the SSM starts to deal with the different banks. They have different rounds. Even banks, they have started to know how to deal with the SSM, in terms of these rounds. And I think that the approach, for instance, that is pursued by the Federal Reserve is, in our view, should be the way forward. It's much more top down. That's the proposal that we are making. So there are also, some let's say legal issues there, but I think that the discussion with the banks should be much more influenced by a top-down stress testing exercise. That's the direction.
Now, Francesco Ninfole from Milano Finanza. Francesco, hi.
Thank you. Good morning. My first question is on the clarification on the AT1 framework. Would that apply only to the new securities? In that case, we could have in the market two kinds of AT1 securities, one with the old framework and one with the new one, more severe. And second question, what should Europe, in your opinion, do if other jurisdictions go ahead with not adopting Basel III fully? Because at that point, Europe could face a trade-off between comparability and a little bit of deregulation. Where should Europe go in that case? Thank you.
Okay, even though we do not enter into that, I can tell you that to have retroactive regulations is not our intention at all. So let's be clear in that respect. We are talking about the way forward. And, we are not going to modify, the characteristics of the instruments that were issued before and that, according to the regulation, were acceptable in order to be part of the minimum capital requirements. That's something that is not there, but I can tell you that that's the spirit that we have. We are talking about the future. We are talking about, how, these characteristics of AT1 should evolve over time, and that they should have, as I have said before, more equity profile. Let's call it that way. Whatever and I think that the direction is clear. And afterwards, the concrete and going into the details and going down to the details will depend on, the legislator. But I think that, there are several elements that can be modified in order to make it more similar to equity. With respect, so only looking forward. No, let's put it that way. And for sure that was the spirit of the recommendation that was decided in the high-level task force, and afterwards that was approved as well by the Governing Council. Well, Basel III implementation. We do not want, there is something that is quite obvious and is going beyond this simplification exercise that now we are implementing, is we do not want to put the European banks in a situation of competitive disadvantage. That's something that is quite clear. So we will have to look. But the information that we have now is that, in the case of the US, because I suppose that this is the jurisdiction that you're referring to, well, let's see what happens, no? But so far, the information that we have, that is public information, is that, the US, is going to implement Basel III. So let's see the details. For instance, with the trading book, there was a postponement, as you know, that was approved by the European Commission, and that was supported by the ECB, because we didn't want to put the European banks in a position of competitive disadvantage. But let's see what happens in other jurisdictions. And this is not part of the simplification. This goes beyond simplification. But this is something that for sure we will continue doing in the future.
Yasmin Osman, Handelsblatt. Please, Yasmin.
Thank you very much. I have questions to the buffers. First, you mentioned how many buffers are replaced by the two buffers which you would like to remain, the releasable and the unreleasable. Then I would like to know if I understand it correct, that the unreleasable buffer works like the conservation buffer we have now. So if banks don't fulfill it, they can't give any dividends to their shareholders. So if this is if it works like the conservation buffer right now, and if I understand it right, that each individual bank would get told how high this releasable and unreleasable buffer is. So will it be still individual bank by bank with regard to the size of the bank, for example? And yeah, that were the questions.
Well, here the recommendation, I repeat again. We are going to have, our proposal is to have two different kind of buffers. Releasable buffers that are cyclical buffers, let's call it that way, that are going to be determined by the national authorities. And that now, this single buffer, will cover, all the macroprudential buffers that are decided by the national authorities. In other words, the non-releasable buffer is the buffer that is going to be determined by the SSM.
But it will be individual. So Deutsche Bank would have a higher buffer.
No. I think that you are going beyond. We are not talking about concrete banks. We are talking about the recommendation and the direction of the recommendation.
You say in the buffer is the conservation buffer and the systemic risk buffer and others. So this is different from bank to bank. So would each bank have a different unreleasable buffer?
Well, it will be determined in last instance by the SSM, but it will be a single buffer. And afterwards, there is something that I have said as well. The P2G, the Pillar 2 Guarantee requirement, will be on top of the releasable buffer, and this is something that will be decided as well by the SSM.
So in this unreleasable buffer, I will have what so far is the conservation buffer, the systemic risk buffers, also the SREP, the Pillar 2 requirement, or is this extra as well?
No. I repeat again. This is this will going to be determined by the SSM, and is the direction of the movement that we decide here, and all the buffers that we have now should be included into only one.
Is this buffer, which is one buffer, the same for every bank? Or is it?
No, it will be determined by the. It will be determined by the SSM.
For each bank.
Yes, and P2G will be for each bank as well.
Okay, thank you.
Okay, very good. Then we have some minutes, so I see Olaf, you have a second question, but yes, we had one question, Vice President, that had not been answered that maybe you want to answer, because it was related to the resolution requirements, and the question was what was the reasoning behind the recommendation to align the MREL and the TLAC, and that was the question that had been posed, and whether this would not increase the regulatory burden of some of these banks. This was the question that had been unaddressed.
No, I think that the question is to align both, because MREL now and TLAC they are for different kind of banks in terms of size, and so it will be a simplification in terms of the question as well, and I have been indicated here, is that TLAC has fewer stacks than MREL. So it will be a simplification in that respect.
Very good. Thank you. And now Olaf is the last person with the hand raised. So Olaf, if you want to have your third question, and then the briefing would be over as I see no more hands raised. Olaf, please.
Thanks. One quick one on the small banks exempt or definition. So it's currently 5 billion in total assets, I guess, and you suggest, the report suggests it could be lifted. What do you have in mind? Would it be doubled, or would it be even higher? Or so, and I guess you don't want to give us give a specific number because it's not in the report, but kind of some kind of ballpark range would be helpful. And then my second question is again on AT1s. What would this mean for outstanding AT1s? Would they be affected by a change in kind of loss absorbing capacity, or would this only refer to new AT1s that will be issued in future?
Well, thank you very much, Olaf. With respect to AT1, I said before that we are talking about the future. We are not going to modify.
The outstanding AT1s wouldn't be affected.
We do not try to apply, retroactive, measures, and that I think that is not. I want to be crystal clear. We are talking about the future. We are not talking about the past. We are not going to modify what has been accepted now. Is accepted. But let's see. In the future, this 81 or 82, will start to mature. And then, the new ones, if the legislator thinks that this is the way forward, will be modified, the characteristics, if they accept that. Okay, so that's, I want to be crystal clear. And with respect to small banks, what we say is not only, I think that perhaps, you want to know, well, where are you going to put the bar? We do not enter into that. What we say is that regardless of the concrete bar, that is something that will have to be decided, and for sure that we will give our opinion. These small banks should have a much more proportional supervisory framework and capital stack. This is the proposal.
Okay, thanks a lot.
I see actually Politico Carlo Boffa, you also had a question?
Yes, hi. Just a clarification on the last answer you gave on 81. If the second proposal is adopted, that would change the current 81s already in the market, because they wouldn't be part of going concern anymore.
Well, I repeat again, there are two proposals, there are two alternatives that we are proposing. And for sure that each one has implications. And we have, included some disclaimers with respect to the second proposal. And this is something that will have to be calibrated by the legislators. So, I think that to say, well, we are going to accept the second or the first. No, we are proposing two alternatives. And afterwards, we will discuss the consequences that each one has. And I repeat again, the second one, we have indicated that it would have, consequences, and we have, very, very clear with respect to that.
Thank you.
Very good. And then, Yasmin, is that a new hand? Is a new question or on a new topic? Okay, if it's a different topic.
Yes. Well, how many buffers will be replaced by the two? You said 10 or 11. I just wanted to know how many.
I think that I have here, let me check. I can tell you. Well, with what we can do, we can send you, a chart with, or we can make it public with, how, the structure of buffers would be modified with, the proposal that we are making. Okay.
Okay, thank you very much.
We can send it to all of you, because I think that to enter into the concrete buffer, I think that this is not for this is something that, we can tell you, now what's, the structure of buffers and the pillars and the requirements, and how, that would evolve in terms of, the proposal. I think that could be, an easier way of dealing with, all your concrete, because there are quite a few buffers.
Yes.
And to start to say that, it's going to be that one, I think that is much easier if you look at it in a chart.
Thank you.
Very good. And on this also, Yasmin, on the website of the EBA, you can actually find like very nice charts and infographics on the actual stack of buffers that you can also pull out from there. So yeah.
Pure number like 7, 8, 10 would have been enough, but okay.
Very good. Okay, then this briefing concludes now. Thank you very much, Vice President, for your time, and thank you very much to all of you. As I said, we have all the material already published on the website. You are free to check it out, and also please to contact us in case of questions. Thank you very much. Have a good day.
Thank you very much to all of you.